Welcome everyone to the European VC podcast. Today we have an episode I have truly been looking forward to because we're going to talk to one of the greats of our industry, one of the founders who have truly been building something that I think we can all truly respect and all learn from. So today, with no further ado, Sacha, welcome to the podcast. You're of course one of the founders behind Glovo.
Hey, thanks Andreas for the invite. Looking forward to it.
Before we start the show, a quick note. If you're building or running a fund, you know it takes the right partners. At EUVC, we only work with sponsors we truly believe should be part of your tech stack. Please do take a moment to hear about them. And if you do, reach out, mention EUVC. It's the best way you can support what we do. Thank you so much. First up, Ace Alternatives. Every fund manager needs clean operations behind the scenes. From fund admin to tax and compliance, Ace handles it all across VC, PE, private debt, and real assets. They're trusted by some of the best investors in the world, and if you want peace of mind and a scale-ready back office, Ace should be part of your stack. Finding deals and managing your portfolio is at the heart of running a fund. Synaptic helps you discover startups before others do, and Portfolio IQ keeps your portfolio data sharp and ready for LPs. Together, they're essential tools for modern fund managers. When it comes to legal, you need a team that truly knows venture. Haynes Boone supports LPs, GPs, startups, and scale-ups across the full fund lifecycle. Smart managers make Haynes Boone part of their stack. We have two at EUVC. Tech Barbecue. Oh my God, who doesn't love barbecue? Europe's startup scene meets the loudest, friendliest family reunion ever at Tech Barbecue. From Nordic founders to global VCs, this is where ideas catch fire and relationships get real. If you're building or backing in Europe, Tech Barbecue is where you want to show up. And hey, if you've got a big fun announcement coming up, want to hit the headlines, or just want to tell your story out, do reach out to us because we'd love to help. And we've got some killer partners to help you get in the right media places. They've helped us land Bloomberg, CNBC, Financial Times, Forbes, and many more for the EUVC Summit, and we'd love to do the same for you.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
So I promised to get you to share something in the beginning that no one knows, or at least many. And you said, Andreas, I actually used to be a racehorse jockey. Tell me about that.
Yeah, I left home at 16. My grandparents knew a trainer, and I was I loved sports as a kid, but I was the smallest guy in the school, and everyone from about 13 onwards, 14 was saying you're a jockey. So I actually had the contact, and he said, yeah. I mean, 16, tell him to pack his bags and come and work for me, and that's how it started. And I rode for about 4 years in the UK, and then the last year in the US before I went to Barcelona and built the next stage of my life. Yeah.
Everyone says that there's nothing better than a former sports person, sports athlete, especially if you're looking to find someone with outlier potential, outlier behavior. Talk a bit about that. Is that true?
I think sports at a high level requires a lot of discipline. And I think you need a lot of discipline to build, I think any company, even small or large. I mean, it's so competitive out there. I mean, for me, we always talk about the unicorns and these huge companies, but actually for me, I take my hat off to any entrepreneur out there, small and large. I mean, it's huge opportunity that you can actually make something successful and live off your own initiatives and not depend on others. I think I take my hat off to everyone in that sense. So I think it does require discipline. So I think there's probably something in there. I mean, I think when I was racing, I literally don't think I took a holiday in 5 years. I mean, I was just so, trying to be successful. And obviously in the case of racehorse jockeys, you have to be disciplined with what we eat. I have to keep my weight down. I'm not a big guy, but anyway, they're super lightweights. And
Yeah. No, extreme sports do require extreme measures and discipline. And obviously, I think there's no better in the business world, no better equation than saying that doing extreme sports is like being a founder in the venture space, because nothing gets more extreme than that. All right, so now you're more than 10 years in building Glovo, of course. We will talk about the competitiveness of your specific industry later, but I'd love to just ask you about how you got started, how you met your co-founder back in the days, and reminisce a bit.
Yes, I mean, so this isn't, it's not the first project I built. I started my first company, I think I was 25, 26 in Barcelona. Just, the first one was in 1999. We built a large portal business, which was basically free services on the internet of it, like Yahoo were used to do, and they had the search engine, free email, classifieds. We built, well, it turned out to be the largest Spanish-speaking portal in the world, very, very successful in Latin America. Millions of customers using our, for home pages, for email search. We had a chat. We had also some other services, and we sold it to our competitor Star Media. We took that company public, went on the Nasdaq. Then my next project after that was actually in the gambling industry with a company called Betfair, who at the time were one of the leaders. They're now the largest online gambling company in the world, called Flutter Entertainment. They acquired a lot of companies and should change their names. They're getting huge in the US. And, I saw what Uber was doing. This is towards after 9 years there. And I saw what Uber were beginning to do with ride hailing, about how a smartphone can change the traditional taxi industry, and with a great UX of how you could just order a cab. And I thought on demand was going to be something huge. And I was looking into that space, and I heard that somebody introduced me to Oscar, who'd just come back from the US. He was studying in Georgia Tech and had a, very similar vision on where things were going. And he was doing a small round pre-seed round to get his project started. And I met him. I really liked him a lot straight away. And I said, look, I can invest as well, but why don't we do this together? And that's really sort of how it happened. And pretty much from inception to closing the round, we literally launched the first version of the app in 2.5 months. We didn't call it an MVP, but it certainly turned out to be an MVP because we had to rebuild everything afterwards. But it got us started and got us time to market and got us out there learning and hitting customers quickly.
Tell me about then international scaling, because obviously you succeeded massively in Spain. And I think a lot of founders in Europe have gone through that journey of getting their first market right. One thing that you truly nailed and that everyone reveres you for was the fast expansion of Glovo, and of course also your nimbleness in getting out when a company, or sorry, when a country turned out to not work out. Can you talk about your principles behind that?
Yes, so we really believed that we really needed to be a global company to survive. I think it was very difficult just to be in one market. There's a lot of capital around for our industry then. Most of our competitors were closing huge rounds. We were generally struggling with fundraising. I'd say we're a little bit later than our main competitors and a little bit less. And so we really struggled to get lead investors, and you'll know about this, but I mean, every round we had to go and get a new lead investor, because the lead investor who invested in our previous round didn't have enough deep pockets to actually lead the next round. Whereas many of our competitors, and LATAM was, SoftBank with Rappi. You can see that these guys, if they can produce some good numbers, they're going to follow on with even more cash. So it was tough, and we had to move very quickly.
Can I ask you, is there a learning there for other founders, do you think, that you got to take on an investor that can go across stages? Or would you say, no, it's just the name of the game. You want someone who's specialized and committed to the stage you're at. And then the next round will always have to sort itself. You can't solve for it by going to a multi-stage.
I think there's a mix. I don't think necessarily there's one size fits all. I think it depends on the project. But there's a massive advantage of having a fund that can just double down on the next few rounds and has that ambition and capital. I think it helps with fundraising. If you're hitting your numbers and you're showing your success, then it saves you, starting a new round and starting, throwing around, decks trying to convince new lead investors. I think that's one of the things that I think most startups that I meet and see, generally when they struggle, it's to find the lead investor. They have a lot of funds who say, no, you get the lead investor and I really like your project. And, it's a vicious circle. So I think there is a huge advantage to getting in with the right VC, if you can. I mean, again, you can't always choose. I mean, people say, I've been asked the question, how do you choose your investors? We beg them. we weren't on the table to actually pick and choose, especially the later rounds. From pretty much our Series A, Series B onwards, I mean, we really had to do. And, Oscar in the end was spending 60-70% of his time fundraising. That's taking that 60% off being CEO of the company, right, and running. So
yeah, and that, of course, if we just should stay on that a little bit, that is clearly a characteristic that was very pertinent and clear for your type of company, because if any type of company, we knew you guys were super cash hungry. This model was very cash hungry. everyone was fighting for market share, and everyone was basically playing the book of blitz scaling, which we all know now is one that's very dangerous to start. Could you talk about your reflections on that? If you think that we as a VC ecosystem, because massive money was obviously lost in this space, do you think that we should have learned something, we should have known better, or is it just where we are and now we're going to do it again with AI and it is what it is?
I think everything's cyclical. I mean, now, we went from huge investments in growth. Don't show me the bottom line. It's all about land grab and market share. We'll sort out the profitability later, to the complete opposite. And at some point we'll probably go, I don't know if it's going to be the hyper growth that was expected 10 years ago, but I think we'll go back to that. I've seen it cyclical. And by the way, I mean, it happened in the first .com era, which I exited to a company was really in that. And it was the same thing. I mean, they did an IPO. It was the largest IPO then in the history. And they'd raised, 90 million pre-IPO, which was the largest amount raised by any company pre-IPO in those days. Imagine 99. That's like a seed investment for AI right now. And if I took back their valuation, they had a 2 billion valuation or something in those days. And yet, if I tell you about their revenues, I mean, you just laugh. I mean, it was just a pure. So I think it's very cyclical, and I think we generate markets and people overreact, and it's like, I think we'll go back to probably investment a lot more on growth when they find the playbooks and the things that really work, and double down. Maybe it won't be as exaggerated as it was, but.
All right, so let's go back then to fast expansion and getting out of markets when you see that they don't work. I'd love to ask you, if we first look at that fast expansion, what are the things that really going through that journey taught you, and you'd say to founders that are tuning in, these are the really important things to have right before you go to a new market?
There's two things I think are key: is really value what's important about your business. I think too many companies, or too many early stage companies, actually focus on too many things. And the reality is, what are our customers looking for, right? They're looking for their favorite content. And in our case, it was, generally restaurants, but not always. I mean, one thing to remind, Glovo was actually multi-category from day one. So we weren't just a restaurant delivery platform, and after COVID moved into groceries and everything else. And we were doing everything from day one. So we've always done groceries. So it's giving the customers, making sure that we have the right content, so that their favorite restaurant is on our app, and excellent UX, and that's delivery time, and and those are the two basic things that. So if you focus on those and forget everything else that are really nice to haves and everything, and you focus on excellent execution, and then that's thing. And I think a lot of companies try and do too many. Try and build something too perfect and too wonderful and everything, and consumers are generally interested in one specific thing or two things, right? And just got to get those right. And then the other stuff is nice to have. And now we've got a lot more, obviously, after 10 years. Now the app has all this stuff, and it's absolutely wonderful and everything. But at the essence, our consumer's still looking for the same thing, right? He's looking for his favorite restaurant or his favorite store or his favorite product, and he wants it, with a delivery with no mistakes. And if we tell him it's going to be 28 minutes, then it's 28 minutes. And then the other thing we did, I think, was really well, and we copied this off the Uber ride hailing then, because they really hadn't launched Uber Eats so much, was the building a playbook of international expansion and building a launching team. So we built a very small, young team, very smart, and they would go to a country, spend 3 months there, get all the infrastructure ready. Because remember, Glovo's a tech company, but it's in fact very retail. Like we touch this, we've got the couriers, the mobility piece of it, and then you've also got obviously all these retailers, and most of them are small businesses who've probably never sold online. So we had to build that infrastructure very quickly, get everyone on board, and then launch, right? And so we'd have a launching team, and they would go country, and they'd spend 3 months in a country. They'd get that ready, get a GM in, and then jump to the next country. So they replicate and building on the playbook and using the same playbook or making it even better every time. And I think we took, that lesson out of Uber, because that's the way they were launching, hundreds and hundreds of countries at one time. And we replicated that. And I think that allowed us to really go very quickly.
Yeah. How did you think about competition when you were going to a market? Did you entirely stay out of a market where you said, here's Wolt and they're quite well established, we'll stay out? Or did you say, it actually means that the market is ripe And it means that all of the suppliers, the restaurants you talk to, they are all ready. They know what it is. They would just basically plug into your platform as well. How did you think about competition?
For us, it was an important factor because, as I mentioned at the beginning, the conversation, that our capital was limited, right? And so we had to really choose our battles. And a good example is, we never entered the UK. We didn't go into Germany. We did actually have a business in France, only in Paris. We never really invested in it, but we were doing quite well in Paris. I think we got to about 10% market share. But in the end, we didn't have the capital to really win that market with good competitors there. So it was a factor of where we would launch an opportunity. To answer your question, if there was probably one good operator in the market, we felt we could challenge that and we'd probably launch. So, a good example is what you meant. Those markets where Walt were there and we launched after them. But if there's two or three investing a lot, then we would probably choose other battles. And in the end, it's probably defined, the markets we're in today, apart from Southern Europe, where we were born and we were early, and we did have a lot of competition, but we've managed to fit it off and done a good job of maintaining leadership here, even though we've had a lot of companies come into the market, invest a lot of money, some leave afterwards. I think it was definitely a factor for us, and we had to do that. And we would choose markets where we could be leader or co-leader. And there's a lot of advantages in our business of being market leader or very close to market leader.
Yeah. Tell me about the principle then to get out fast when you could see that a market isn't working. What were how did you see that, okay, this market is not for us, we should pull back out? How did you make those calculations, so to say? What was it that really, did you have one key metric that showed you, okay, this is not for us, it's not working? How did you make that decision?
Yeah, I think generally growth. If growth's not happening, you're seeing a lot of competition. Brazil's always a great example. We launched Latin America. We launched Southern Europe. So we're in Spain, Italy, Portugal, and Paris. And then we launched Latin America and went to about 10 countries there, including Brazil. And Brazil, we've noticed very quickly that, the playbooks that were working everywhere else in Latin America and pretty much were not really working. And we came to a conclusion very quickly that a couple of things that made it very different to the market and made us spend a lot of money very quickly, but also leave very quickly, which is obviously the right thing to do. And is, first of all, the company that's been operating there, the incumbent, iFood, is an amazing operator. They have great partners. They have a great, excellent service. At that point, probably had 95% market share. Great company. So we didn't really bring anything super additional on top of that would actually take their customers and start using Glovo, which generally happens when you go into a market with an incumbent who's generally their UX isn't that great. They're probably sending the orders to the restaurant. The restaurant's doing their own deliveries, and then 20% of the orders get lost. And then we come in and we just have amazing service, and that. So I think iFood, amazing operator, still there, still market leader. And then at the same time, we launched, and our two biggest or largest competitors in Latin America, which was Uber Eats and Rappi, launched at the same time with huge deep pockets, spending a lot. So there's this carnage of three new players, and we just said, look, get out here. So we quickly left and we focused on the rest of Latin America, which turned out to be the right decision.
Would you say that we all in venture, of course, have a very strong thesis and love for network effects? Would you say that network effects have proven out to be important for the last mile delivery market, or actually it was? Yeah,
I think it's even more extreme. I can give you the cycle, right? So, consumers, will probably choose my app for the two reasons I said. Now I've got the best restaurants or your favorite restaurants, and I offer generally a super excellent service. Right, the excellent service I can control a little bit, but to get the partners. Now, why is the best partners going to join my platform instead of my competitors? Generally because I can bring them more orders. But how do I get more orders? Offering my customers the best restaurants. So that's a vicious circle by itself. And then, of course, couriers, right? Couriers will make more money. The more liquidity there is, the more orders they're doing per hour, the more hours I can offer them, the more days of the week I can offer them. So it's a vicious circle. So that, I'll get more couriers want to work with me instead of another platform because I can give them more orders. How do I get more orders? Giving the best content. How do I get the best content? Giving them. So it's a vicious flywheel there that is a clear example of network effects. I think more than any other business I've been involved in. Whereas normally it's a two-sided marketplace, with a service and a thing, and you can work your service and get it right. But this is actually dependent.
Tell me about another important piece of all of this, of course, which is, so you have network effects as one core driver. Then oftentimes you will do as much as you can to get exclusivity deals. And I feel like in the beginning, I'm actually not sure I'm right about this, but I felt like in the beginning, most often you'd only have one option. Like if I want it from that restaurant, it'd have to be Bolt. If I want it from that restaurant, it had to be Uber. Now I'm starting to see that there are multiple in one. Am I right in that?
Yeah, I think generally most brands will probably work with multiple platforms today, and I think it's part of the strategy of how they feel they want to have the maximum reach. By the way, it's not all. I think one thing the retail businesses have learned over the last 10 years, and it was a very different conversation I was having with restaurants and stores and supermarkets 10 years ago, was they saw us as actually competition. I'm taking customers, instead of walking into the restaurant, they're going to order with me. And I said, no, it's not about that. Actually, you're competing with cooking at home. Basically, they'll order from you instead of cooking themselves. I mean, that's everyone realizes that today. I mean, the way we all use the apps and the way we all go to the restaurant. So I think there's this sense of we're seen as a competitor, and then restaurants in the beginning didn't want to work with multiple partners. They wanted to, test out with one. See, now they realize it's about reach, and we're not just an amazing place to bring them incremental revenue and incremental orders. We're great for branding. So, in some of our big cities now, thousands, sometimes hundreds of thousands of people are looking in my app every day, and they're seeing your restaurant. And in my competitor as well, that that are going into them, they're going to see your restaurant. So there's a lot of branding around there and related to that. And I think what restaurants is the platforms are generally it's a great additional channel to all the other channels that they'll be working on, and they're building their own channels as well. Whether it's got delivery or not, it's certainly got. You can order, reserve your table, or they can do their marketing through there, and they're now running their own CRM. So everything's evolving, and I think we're part of that. And sometimes we'll have preferred partnerships, which means you can work hand in hand mutually and help them build a brand, knowing that they're going to only work with you, which is fantastic sometimes. But I think there's a tendency more and more to be multi-channel by most brands.
Can you talk a bit about that partnership dynamic with restaurants? What are the principles that can be deduced from it? Because what you, of course, have is a product towards us as users, but you definitely also have a product towards the restaurant. And the restaurant picks between, am I going to do multi-channel, am I going to do Volt alone, or am I going to do you alone? Some have microfinancing and those types of things. I don't know if you do as well. Could you talk about that?
Yeah, there's a lot of services, but again, it goes down to one or two key things, right? And what do they want? They want incremental revenue, incremental profitable revenue. So the commissions need to fit into their to their business units and the unit economics. Some restaurants, the cost of product are higher than others. So it needs to fit in. What's the average basket size? But I think they're looking for visibility, they're looking for brand, and they're looking for incremental revenue. And I think everything outside of that is nice to have, but it's not the key. And then, of course, they want an excellent service, because if the service isn't perfect, we all get blamed, right? So I'll give you an example. If a restaurant misses a product, got three things to put in, they forget one, Glovo gets the blame often from the customer. I'm perceived as the one who made the mistake.
Yeah, I've been there.
Or the other way around. No, imagine we have problems with delivery, and it's raining and we're saturated and we can't do the delivery times. Then the consumer will sometimes blame the restaurant for that, right? So we're in a complete partnership of doing great UX, and I think those who really value their brand, the ones who really look after the customer when they walk in the restaurant, are very concerned about maintaining that level, and that's why service and great UX is so important. And those two things, and so what I said at the beginning, it's not just about incremental revenue. That's super important, obviously, and it's the driver. It's UX and good volumes of orders. The rest is nice to have.
Yeah. And as you said in the beginning, just to make it abundantly clear to anyone, the most important thing is that almost all your value to a customer comes from one or two features, and those two you got to nail, and the rest are just nice. Let me ask you another thing, because we spoke about getting out of a market and realizing that a market doesn't work. You said that for you, the clear metric that signaled we got to get out of here is growth. I think that with your journey in venture and tech, I think you can teach a lot of people how to think about sunk cost. So how do you pull your plug on something that you actually thought would be really good and have plowed a lot of money and time into?
Yeah, being radical. I mean, being very mature about, we all have ideas and things we love, but if the data's not coming back, and it's really, at the end, you just have to pull the plug on it and focus on less things. I think it's very important to focus on very few things and do them really well, than do a lot of nice to haves. And of course, we've had a lot of, above all, product things that we've launched and tested and didn't work. And there was a high amount of, optimism and I think it's important, like you said, similar with what you mentioned about markets, is to learn very quickly what doesn't work and cut it, and not dedicate resources to it when you can dedicate those resources to something that's really valuable and driving. And sometimes they're the less sexy product stuff that are more important, unfortunately. And, we all have to be creative gurus with ideas and be the next, next thing in delivery app that's going to change the world. But at the end of the day, it's just doing the basics super right and incrementally every day.
Now, let me ask you, doing everything right, incrementally, getting better and better and bigger, you are scaling out of Europe to the rest of the world. You're very busy in a lot of emerging markets, especially. Can you talk about that, the learnings from that, how it's different from scaling inside Europe, or is it not at all?
Yeah, it's very different. I mean, we're in very different markets. So we were born in Spain, our first market. We launched very quickly in Italy and Portugal. So we were born in Southern Europe. A lot of similarities between the markets, not exactly the same, but very. And we saw an opportunity to launch in Latin America. Obviously, there's the language and certain cultural similarities. And there was, at that point, not too much competition. We had iFood in Brazil, of course. Then you had Rappi, who's in Colombia, but beginning to expand. And you had a Uruguayan company called Pedidos Ya, who were growing in Uruguay and Argentina. And then Uber Eats as well, were just getting going. So it was sort of, and we launched there very quickly. We launched about 10 markets almost immediately. And it went really well, actually. I mean, but there was strong competition and with deep pockets. And we had an opportunity to exit the market successfully. It was an opportunity with one of our competitors. And we were just beginning, we just recently launched in Eastern Europe. And that was going very well. And in both Eastern Europe, also Central Asia and Central Eastern Europe, the Balkan region. And we thought it was a very good decision to have that opportunity to take the capital from Latin America and double down in Eastern Europe. And that's what we did, and let the competition continue in Latin America, which it has done. And it's still, very, very tough market, very good competitors, a lot of money, a lot of capital. And so going just back, there's a lot of differences. There's a lot of differences with consumers' expectations, with mobility. I mean, some cities, I mean, we got a wake-up call. We launched Ukraine, and we got a wake-up call the first winter, and it was like, 3 feet of snow in the city. And it was like, couriers can't use motorbikes or bicycles. Forget that. We had them, and the Ukrainian business invented the first, we had a walker. So we never had a courier walking. And they worked quite well, actually, surprisingly well. And then, they'd jump, and obviously in the winter they'd use cars, and so we had to really learn that. And then obviously served us in a number of countries where it gets pretty cold in the winter in that region. So there's a lot of differences from every aspect. And then more recently, which is I think our fastest growing and emerging areas, is Africa. And there, of course, there was literally a lack of digitalization, not so much with consumers, but certainly with retailers and inner cities. So, pretty much all our restaurant stores, their first digital initiative was with Glovo. I mean, they weren't even on Google Maps, for example. We had to add them on, for the mapping to work on our app and things like that. So, that's amazing as well, because you go then you just see the impact and the positive impact you can have in that. And now every time I go down there, literally it's changing dramatically from one, from every semester. You can see the evolvement of how quickly that region's moving.
It's incredible. Now, I want to ask you about something that I was about to say almost all startups will sometime go through. And that is, of course, due to the cyclicality of venture. Something is tough one day, and then a couple of years later, it's not that hot anymore. And you, of course, very much experienced that with the tech reset and then the impending consolidation that everyone was expecting and played out. And for your situation, you ended up being acquired. Can you talk about that journey, managing through that, keeping the troops together in a process or in a time where everyone in the industry, also outside of the industry, in mainstream media, would talk about how last mile delivery is going to completely be wiped out?
So I think in our case, it was very much, we're pretty much in survival mode from year 3 onwards, when we really had to compete on the world scale with big competitors. Trying to fundraise, trying to convince important funds that we could be one of those players. No, in a very consolidating market where size and market leadership is very important. So there was this lack of, I think, from top tier VCs in the belief that a small, startup or scale up from Barcelona could compete on that world scale. And it was, I think our story is really about survival. And, and then how did we do that? Going back to your second one, I think one thing I think we've done extremely well is our core values as a company and our culture. We've focused on that from day one, and literally those values have literally not changed pretty much at all. The descriptions and how we communicate to the team have, because there's, but at the end of the day, the basics. And there was this perception within our team that we're David against Goliath, which is hugely powerful if you can transmit that message and get everyone aligned. And then the victories, when you do become market leader in a country where your competitor has a lot more capital, can hire a lot more senior people, blah, 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 and you actually become market leader there, it's like, wow. And then I think kept everyone united. And a good example is, the management team, the C-level under Oscar. I mean, pretty much it's hardly changed. I mean, there's a few people who've left but literally the core, we're talking, obviously I've been there since day one since Oscar, but literally we've got probably 3 or 4 C-levels who've been there 8 years. And these were the C-level that we could actually hire with a little bit more seniority because we had a bit of capital and a serious project that we could buy into in the first few years. No one interesting is going to probably think of a Glovo, but we managed to convince a few, and they're still there today, and that's just a sign that it's it's their baby as well, right? And that's I think is important.
Another thing culturally that you did not mention yourself, but which I think truly stands out, is of course the requirement, so to say the cultural requirement, that every executive, everyone on the team will do deliveries now and then.
Yeah, we have a global program called Glovo Cares, which basically all staff can go out and we do it in teams. Sometimes we do it individually. When I travel, I try and deliver. So I was in Ukraine 4 months ago. I did a couple of orders, spoke to a couple of partners, and in Africa as well. I love going there. It's super fun. It's an adventure. You realize that how easy it is in some other places in the world compared to. But I think it's something we do because it gets you in touch with the pains of what it is for a courier, but also when you go to a partner and you see the issues they have with an order, and I think it's a valuable thing. Yeah, I mean, it comes from the beginning of Glovo, which we didn't do it because we wanted to, but in the first year, in the evenings, especially in Barcelona where we launched, I mean, we get too many orders and we didn't have enough couriers, so we'd pretty much all get on our bikes and start doing orders, which is a regular occurrence, especially the weekend, and if it was raining. So it sort of stems from that. Yeah, I mean, it's a cool thing. To me, it seems fairly normal that a company would want the team to feel what it is, to be under the bonnet and to feel the pains of the daily operations.
I don't think it is fairly ordinary. So, but
okay.
Now, Sacha, let me ask you another question, and the final one on the acquisition part. I'd love to ask you a bit about your learnings from going through that journey, and what you'd say to founders that are thinking and trying to manage through this type of thing, or getting at least their mindset prepared for acquisition talks.
Our case was a bit unique, I think, and special in the fact that Delivery Hero invested quite early. So already in our Series C, I think it was. And obviously, we had a potential acquirer in our cap table, and obviously all the other, of our investors were a little bit concerned as, okay, I mean, it's clear that they're a bigger company, they'd want to be, and I think it was always on the table. We wanted to be independent for as long as we could, I think. That's what we had, dreams of maintaining it independent, but in the end, it made so much sense joining them. We had a great relationship. They were on our board for many, many years, Nicholas and PJ. So we knew them very well. They're very entrepreneurial. It's a holding company per se. So basically, they have a lot of brands all over the world, generally market leaders in different parts of the world. And so there's a sense of a lot of autonomies. And to be honest, I mean, it's still global. People still believe that. There's a lot of value, a lot of learnings from the other brands. I mean, we've got some amazing companies. I mean, even Pedidos Ya, who threw us out of LATAM, and now we're best friends. Talabat, what an amazing company that is. I mean, just meeting their leaders and learning all the time. And hopefully they're learning a few things from us as well. So yeah, it's a unique thing, as in we knew them. It's a great relationship. We knew that we could still continue building the way we're building. So if you go back to others, I've been involved with other acquisitions. I think the way I'd frame this is I very rarely met a founder, me included, who've had a couple of exits before as well. I very rarely met a founder who felt it was a mistake selling their company. And I've met a lot of founders who thought it was a mistake not selling the company. So
that's a beautiful point, and I think it's incredibly important. And I think it's if we just pull the lesson for founders completely out clearly, VCs do not always want an acquisition to happen, because oftentimes it's not in the best interest of a VC. They would rather go for the moonshot of an IPO or whatever than they would sell out in their terms, because that would give them a lower outcome. And that, of course, is a major problem or something to manage as a founder. That you're used to being able to rely on your VCs a lot. You're used to sparring with them on a lot of things. But on this one point, a VC will very likely have different interests than you as a founder.
Absolutely. But a lot of things as well, to be honest. I think, VCs are in the game to make money and give a positive return to their LPs, so they'll come back in many years. And I think that's legitimate. And I think we shouldn't be mistaken about what the objective is. And I think, founders always to build, to work your ass off for everyone who's investing in you and give them the return on their investment as best you can. And it doesn't always work out, but as long as you tried maximum and you were disciplined and you did everything in a legitimate and ethical and every way, but there's a point where, there's different alignments. And I think founders need to make sure they're well advised impartially. And also it's their moment. Sometimes, it happens, but I mean, you just can't keep going, the rate. And, if you've got another 5 years ahead, it seems like a wall. So I think there's different times, and I agree. I think they need to be. Having said that, I mean, we've had VCs who've been so aligned with what we wanted, but not out of their own interest. I mean, as in, look, I'm founder friendly. I really support founders. It's not just about my own interests. And, they've supported us in a lot of the tough decisions we've had where some of our, board members were not aligned and defended us. So I think it's not one size fits all. It's not one. I think some VCs are very founder. I'd hope Yellow we'd be that. I think we've been there, and I think we put our founders to try and support them and be that internal advisor independently of the interest of the fund. That's what we want to be, and also, I mean, I'd help any founder anywhere, right? And whether I'm an investor or not. We've had some investments which didn't work out. They were oversubscribed, and we're new fund on the block, a lot of better brands. But they've turned us down, but we've helped them the next day. By the way, this company would be interested in your service, and I've given them an intro, and I just want them to be as successful as possible, especially European tech companies. We need these European tech champions more and more. So and they're not always going to be funded by Yellow.
Yeah, and Sacha, I wanted to move to that because I wanted to ask you about Yellow. How does Yellow fit into the world of Glovo? And of course, also pull out the point that this is a beautiful example of the halo effect of great tech companies. Because one thing is Yellow VC, but you also have Glovo House, and you also have Glovo Startup Campus. And I think that it would be beautiful if you just round off this conversation talking really quickly about the importance of what you're doing here for founders and how it fits into the Glovo world.
I mean, Global House was happening organically. I mean, there was a lot of employees, top employees generally as well, the ones we wanted to keep, who were, leaving Glovo and setting up their own companies. And we're obviously super proud and very supportive. And we came to the conclusion that all this top talent that we want to keep, of course, if they want to be entrepreneurs, they're gonna do it anyway. There's nothing I have to keep them. They're gonna do it sooner or later. So we may as well build the tools already and let them know that we have this program that can facilitate that change. So in essence, we actually make it easier for them to leave, which sounds, but they're going to do it anyway. So we may as well help them. And I think, our legacy at Glovo will probably be, the incredible amount of unicorns created by our team. And what I heard the other day, and I haven't been data verify this, but I mean, it came from very reliable sources. Apparently Delivery Hero, with all its brands, including Glovo, but Delivery Hero and, Foodora and the European, they've built more European tech startups than any other European company. So I need to double check that. That's pretty impressive.
And the people that are part of that journey, the people that try to open up new markets for you, as an example, that SWAT team are going to be absolutely incredible, either founders or operators on an executive level for new startups that are doing this.
Yeah. And they've learned, I mean, we're such a fast moving, competitive, high bar industries, and our competitors as well, they're super tough, that the talent that comes out of this are used to hard times and used to competing, and it's not an easy ride. So they're going to be in a great or better position to build a company, I think, than if they weren't. So I think it makes a lot of sense. So I think, that's super exciting. I'm delighted when I see one of my friends and one of my colleagues start a company, and I'm like, wow, good luck. And I hope you build the next huge European tech champion. And then Yellow came about a little bit differently. I've been investing for many years as a business angel. Oscar as well recently, probably invest in 40 or 50 companies. We thought it'd be great to build a brand, to build probably, aspiration is to build one of the leading pre-seed, seed European brands that, the idea is when a top founder has a project, we're the first phone call. Would be a nice way to frame where we want to be. And, we met Adam, who's the other general partner, amazing guy. He was just moving into his phase of, he was in Atomico. He wanted to set up his own fund. And it matched perfectly because you have the investor team with a very strict and disciplined mindset. And you have, the operators, the people running business that are actually more emotional, more about personalities or things like that. And I think it's a great combination. And then the other thing I think is super important, and I've seen that with a lot of founders, I'm not taking anything away, but many founders who then go into venture capital, I mean, they get a little bit disconnected from real operations. And obviously we're full-time still, so we're full-time operators in a very tough business. It's still tough. It gets tougher every year. And so we're very in touch. And I think that's great, because then we have a lot of access as well to people, to network, to potential clients for B2B. And I think it's a nice spot. And we're starting, I think things are really starting to work there. We're not lead investors. So we're generally working with the top pre-seed funds in Europe. They'll lead but we're getting called by them now that they see we bring a lot of value to their portfolio companies. And when they have something sweet, they often give us a call. Do you want to join us on this one? Which is a great place to be as a fund. And the team is excellent. I mean, the full-time Yellow team is like incredible. So excited. And I'm learning, by the way. I'm learning a lot, which is also, I mean, the most important thing about everything, right? Is that you're learning. Because when I was investing as a business angel, it was very emotional. I really liked this person, or I really liked the idea. I wasn't really thinking about potential exits or size of the company. I was just thinking, this is a cool project, and I want to be part of that. And now it's much more disciplined about what we're doing as a fund.
Sacha, thank you so much for taking the time. I believe you're in Morocco or somewhere, opening up another important market, of course. So thank you so much for finding the time to talk to us here. I think a lot of founders that tuned in today will have learned a lot from you. Thank you so much.
Hey, thanks, Andreas. Great talking to you. See you soon.
Before we start the show, a quick note. If you're building or running a fund, you know it takes the right partners. At EUVC, we only work with sponsors we truly believe should be part of your tech stack. Please do take a moment to hear about them. And if you do, reach out, mention EUVC. It's the best way you can support what we do. Thank you so much. First up, Ace Alternatives. Every fund manager needs clean operations behind the scenes. From fund admin to tax and compliance, Ace handles it all across VC, PE, private debt, and real assets. They're trusted by some of the best investors in the world, and if you want peace of mind and a scale-ready back office, Ace should be part of your stack. Finding deals and managing your portfolio is at the heart of running a fund. Synaptic helps you discover startups before others do, and Portfolio IQ keeps your portfolio data sharp and ready for LPs. Together, they're essential tools for modern fund managers. When it comes to legal, you need a team that truly knows venture. Haynes Boone supports LPs, GPs, startups, and scale-ups across the full fund lifecycle. Smart managers make Haynes Boone part of their stack. We have two at EUVC. Tech Barbecue. Oh my God, who doesn't love barbecue? Europe's startup scene meets the loudest, friendliest family reunion ever at Tech Barbecue. From Nordic founders to global VCs, this is where ideas catch fire and relationships get real. If you're building or backing in Europe, Tech Barbecue is where you want to show up. And hey, if you've got a big fun announcement coming up, want to hit the headlines, or just want to tell your story out, do reach out to us because we'd love to help. And we've got some killer partners to help you get in the right media places. They've helped us land Bloomberg, CNBC, Financial Times, Forbes, and many more for the EUVC Summit, and we'd love to do the same for you.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.